Hey guys, Aryan here. Have you heard about overtrading? What is overtrading and why you shouldn't do it? Let's talk. Hi, I'm Aryan and this is I Invest, where we talk all about investing and trading. So have you ever thought about why we invest or trade instead of going and gambling? And what's the difference between gambling and investing or trading? And really, why should we spend hours and hours in front of the monitor to eventually lose our money? If so, what is the difference between trading and gambling? One of the ways that people lose a lot of money in both gambling and trading, especially in trading, is greed. Greed is one of the biggest enemies of traders, especially the ones who tend to overtrade. The market always punishes those people who act on greed and spend hours and hours on the monitor, but instead rewards those moderated traders who spend much less hours in front of the monitor, but they have plans for their trade. As a trader, we know that anything can happen in the market, and market can go high or low and anything in between. But in trading, you do not think like a gambler. You don't rely on your chances and go to the trade blindly. That is the first rule of every trader, even the most experienced one. And that is the first thing you forget when you start to overtrade, because then the greed starts. Nature of the market is based on many different things. The one thing you should accept is that market is not going to continue its trend for you or against you. It has no reason and sometimes can continue for hours and hours in a different direction or in the same direction. Going high or going low, it just could have no reason, and you can't have consistent result without understanding this. If you want to be consistently profitable, then you have to accept this. The next factor that we can talk about is if we accept that there is no uncertain result out of this market, how can someone be profitable in the market? Well, in life, business and trading, we have this thing called probabilities. If you understand the probabilities and also have a plan, then you start to act as a casino, not a gambler. In any situation, no matter what, if people lose money or win money, casino has its own portion of profit. Every year, people lose money or people win money in the casinos, but there was no year that casinos lose money. Why? Because they know their probabilities and they develop these games that is acting on behalf of them and in favor of them. Yes, you can win in these games, but not continuously. The fact is, when they develop these games, they have an edge over the probabilities that in every 1,000 times you play this game, there is a probability of you losing and you winning. And most probably the probability of you losing is much higher than you winning. But there is also the fact that we call it house. But the fact that most people don't understand is house is not winning all the time, but it's winning over the time. And if there is one thing you're going to take away from this video is you have to win over the time, not in one time. If one trade is going to make you or break you, I'm telling you, you're going to be broken. If you can survive over a long term, then you have a higher probability of success. This is the first rule of investing. You shouldn't lose. And if you lose everything in one go, then you don't have the money to come back to the game. Game continues, people continue, and the casinos win. But you don't have the edge to come back and then continue the game. Okay, long story short, you have to act like a casino, not a gambler. That's the way. How can you start acting like a casino? With having a plan and knowing the patterns and the nature of the game. And also you have the tools to change the odds. You have the tools to change the odds against you. And those tools are the same as casinos use the games for winning over the time. You can use trends, moving prices, and indicators, supports and resistance levels. These are just the tools to give you a better probabilities. But the rest is your planning and how you approach the market and know its movements in different times. Now this is where the journals come in. If you have a trading journal, then you can learn from your past, your mistakes, and know what are your strengths and weaknesses. Then you can act according to your own personality. That means you act exactly like a business. You know what are your numbers, you know what is your market, and then how to act to get to the next goal. And remember, you can't be successful overnight or weeks. It should be consistent. Remember, casinos, they don't have one game, they have many games, and their overnight goal is to survive. Their profitability is depending on them being alive in the game and be over a long term. It's important to know your winning rate, but then it's as equally important to know your losing rate as well. If you know your losing rate, then you put realistic goals. That's important because then you know that you're not going to be successful in every single trade you're doing. There is a probability of losing, and the probability means it's probably you're losing or it's probably you're winning, and it's not depending on you. You're going to change the odds in favor of yourself, but there is still a probability of losing. You have no control over the market, remember? And you're aiming for the long game. Now, to make it even better for ourselves, we have to have a measure of the risk we want to take and then the rewards we want to gain. This is called risk to reward ratio. It means if you're going to risk $1, you have to at least get $2 or anything above $1 in return. That's the edge we're talking about when we're talking about the casinos. If they're going to lose $1 and gain $1 in a long run, they don't have any profit. But if they're going to lose $1 and gain $1.1 in a long run, they have profit. Even if their probability of winning and losing is 50%, then they're going to be end up with profit. A small one, but it's still a profit. The rule of thumb is that many traders agree on having 1 to 3 risk to reward ratio, meaning $1 risk and then you expect to gain back $3 in return. Of course, that's the best you can aim for, but it's not that high all the time. You have to know your own returns and also to know yourself on how risk averse you are or you're not. So that depends on your ledger again. If you have the ledger over the time, you can see how painful is risking for you. And then you can, the other tools we have that practically no one else in the history had. You can find any community you want in the internet for any trading style or any market. Being in that community helps you to verify your theory of any trade or any strategy. So talking to other people and seeing their opinion about some trade or a strategy or the market can confirm your theory, and you know that it's not just based on your own expectation. But be careful that you have to have your own strategy and accept the risk and rewards you're going to take, because at the end of the day, this is your decision and this is your money, and what you're playing with is the market and your future. At the end, you really don't know what's going to happen next minute in the market. What we can do is to be on the side of the trend and follow the trend. As the saying goes, trend is your friend. By doing that, you can maximize your probability to be profitable. And remember, you have to survive to see the profits. If this information was useful to you, please like and share so other people can see this and then stop overtrading. Thank you so much for watching this, and remember to comment me any question or suggestion if you have in the comment section down below. Thanks, see you later.